So last time we left off here, and the last thing that I mentioned was that D1 was also D0 times 1 plus G. Now, using the substitution principle, we can actually just go ahead and write the equation this way. If you are lousy at algebra and you don't understand the substitution principle, go ahead and put this on your note sheet. And we're going to be actually using this form of it today when we do supernormal dividend growth. So from this constant growth of dividends equation, we come up with something called the dividend growth model. Did you see the guy at the door? Wrong place. Okay, so what we're going to do is we're going to rearrange that to find the required return. And when we do that, just a little bit of algebra here, and we end up with the required return is equal to D1 over P0. D1 over P0 is the dividend yield. So that first part is just the dividend yield. And if you think back to when we talked about the two kinds of gains you could have, we said there was the dividend yield, and what was the other thing? There's dividends and there's capital gains. And we said total returns are equal to the dividend yield plus the capital gains yield. Well, hey, if D1 over P0 is the dividend yield, what does that mean about G? It's got to be the capital gains yield, right? And so the amazing thing that we've just discovered here is that in stocks with constantly growing dividends, the stock price grows at exactly the same rate as the dividends. For firms with constantly growing dividends, the stock price increases at exactly the same rate as the dividends. Because after all, the capital gains yield is just the rate at which the stock price grows. So this is pretty cool now. We can come up with all sorts of amazing things with that. So we already said that D0 is equal to 1 plus G times, or so D1. D1 is equal to this times D0. What would we have for D2? It would be 1 plus G times D0 times another 1 plus G. Because this is just D1. You see how that works? And so what we're eventually going to get to is D sub y is equal to D sub x times 1 minus 1 plus G to the x, y minus x power. Sorry, a little confused today. Y minus x power. So if I have D7 and I want to know D13, all I have to do is take D7 times 1 plus G to the 13 minus 7 power, which is 6. And so D13 is just D7 times 1 plus G to the 6th power. This formula always works. This formula always works. And I might ask you something crazy like, what will the dividend be in year 72? Do you really want to have to keep multiplying by 1 plus G? No, just remember this. And we said that the price grows at the same rate. So we could also say P sub x is equal to, P sub y is equal to P sub x times 1 plus G to the y minus x. Because remember, the price grows in exactly the same fashion as the dividend. Now, I will undoubtedly give you a question on the exam that asks you to figure out the price at some point, and I'll start you off with dividends. And some of you will solve out for the dividend like P14 to find P13 and things like that. But it's actually a whole lot easier to just find the price right now and then use this formula to skip it forward. Hopefully we'll run across that in the examples for the exam review, and I'll be able to walk you through it. Okay, any questions on this? So what is D1 over P0? What do we call that? Dividend yield. And what do we call the other thing? Capital gains yield. Very good. Okay, now we're going to move on to supernormal dividend growth. And I told you that in the short term, we could have G greater than R in the short term. But then, of course, we're basically going to settle out eventually to that constant growth. And the idea here is that for newer companies, that constant growth dividend model might not work. When a company first starts paying dividends, they kind of dip their toe in the water. Example, if you look back at Apple, Apple was almost worth $1 trillion at the time, and what kind of great dividend do they start out with? I think it was 25 cents per share. It's tiny, right? But then what do? As they see that they're not going to have a lot of problems as a result of paying the dividends, then they start to increase the dividends. And so they grow fast at first, and then they will settle out to a stable growth rate over time, or at least that's the theory. Okay, now the problem is that there is no slick algebraic way to solve these. I know how you guys hate algebra, but this is even worse. So it's a method instead of a formula. But all we need to do is remember that the price or value of anything is the present value of all the future cash flows discounted at a rate appropriate to the risk. And so that's how we're going to solve this too. So our first one is to find the individual dividend amounts up to the start of constant growth. And then at the start of constant growth, what we're going to do is figure a price at that point that represents the value of all that constant growth dividends out beyond that. And then when we use our present value, we can pull that back to time zero. We're going to add that and the present value of all those dividends together. And that's going to give us the value of the stock today. Okay, so best way to do this is with an example. We've got a company. It's going to pay a dividend of $1.15 1 year from today. Is that D1 or D0? D1. Then over the next 4 years, this dividend will grow at 15% per year. After that, the growth will settle down to 10% per year. What is the value of 1 share of the company's stock today if the required return is 15%? Folks, I'm going to tell you that if you approach these problems without drawing a picture, you're being quite foolish. And once I demonstrate to you my patented kindergarten method for figuring these things out, you'll understand why we need the picture. By the way, time zero, what dividend do we get at time zero? We never get the dividend at time zero unless I tell you otherwise, and I will never tell you otherwise. So we don't get that one. What dividend do we get? Well, we know at time one, they tell us that we're going to get $1.15. And then they say for the next 4 years. Sometimes people get confused and they're like, is that year 4 or year 5? So here's what you do. You always start with the dividend they give you. In this case, they gave us D1. And then they say the next 4 years. And this is what we do. We go 1, 2, 3, 4. That's the kindergarten method right there. Use your finger. 1, 2, 3, 4. Right? And so 2, 3, 4, 5. It takes us up to year 5. And we know that those are going to grow at this rate of 15% per year. So they're going to grow at this constant rate of 15% per year. And then after that, we know they're going to grow at a constant rate of 10% per year. Let's see here. Oh, by the way, if they gave us D0 instead of D1, and then they said the next 4 years, what would we do? Well, we would start at D0 to do the kindergarten method. And in fact, I'm pretty confident that the one on the exam starts at D0. And so your ability to remember to start on that dividend that you're given, D0, before doing the kindergarten method may very well determine your ability to solve the problem. So we always start with the dividend they give us, and then we use the kindergarten method to get to the end of constant growth. Okay, so they said the first step was to find the individual dividends up to the start of constant growth, and then we also need to find a price at the start of constant growth that represents the value of all these things going forward, all the dividends going forward. Keep in mind, this goes out till the end of time. So if we want to find P5, we know that that is D6 divided by 1, let's see, R minus G. D6 over R minus G. Now, have we calculated D6 at this point? No, we've only calculated, we're going to calculate D5. What could I put in here instead of D6? Yeah, so D5 times 1 plus G divided by R minus G. And so that's how we're going to go about solving this problem. By the way, notice that this formula always gives you the price in the time period before. On the exam, I will give you D3. And I will ask you, it starts at D3 and moves on out in time. No dividends for time 1 or 2. And I'm going to ask you to tell me what is the price at time 0. How do you solve that problem? Well, we know that P2 is equal to D3 divided by R minus G. And all we have to do then is use our present value function to move that back in time 2 spots. And that gives us P0. So that problem is really easy to solve if you know that little trick. Most people, what they do is they end up thinking that they're solving for P3 instead of P2 given D3. So if we don't have the 1 plus G, we're always solving for the one before. If we're trying to solve for the same period, you got to put the 1 plus G on there. That's just the substitution principle. Okay, so now we have our picture. Oh, by the way, there are all these other dividends that are going out till the end of time. So I can't draw them all. So that's what's going on beyond that. So how do we go from here? We're going to use the CF keys on our calculator. We're going to use the CF keys. Do you have your calculators out? Don't you have your calculator out? Go ahead and get it out. First thing we're going to do is CF, second, clear work. What cash flow happens at time 0? 0, nothing, right? So we're just going to arrow down. What cash flow happens at time 1? Yeah, 1.15. I'm going to do 2 things here. I'm going to hit enter, and then I'm going to hit store 1, and you'll see why here in a second. Arrow down. What is F01? Yeah, and they all only happen once because we've got growth all the time, right? Oh, sorry about that. Arrow down. C02. How do I figure out D2 given D1? I'm going to call that first growth rate G1. This is G1, and this is G2, because we've got 2 separate growth rates here. But to find D2, I'm going to take D1 times 1 plus G1, and they told us that first growth rate is 15%. So here is all I've got to do. Where did I store D1? Yeah, so I say recall 1. Then I'm going to multiply by 1 plus G1, which is 1.15, equals, and I'm getting this number right here. And I'm going to do 2 things. I'm going to hit enter, and I'm going to hit store. What should I store it as? 2, very good. And now I'm going to arrow down. Once again, all the F's are 1. C03. Any ideas what I should do here? Yeah, recall 2. And we're going to multiply by 1.15 equal, enter, and then we're going to store that as what? 3. Arrow down, arrow down. What do I recall here? Yaro, what do I recall? You lost track. Vinicius, what do I recall? Yeah, very good. Recall 3 times, what do I multiply by? Very good. Enter, and what do I store this as? Store 4. Arrow down, arrow down. What do I do here? Recall what? 4. What do I multiply by? 1.15 equal, and I'm going to enter, and I'm also going to store 5. You say, why are you storing 5? You're not going to be doing D6, but you'll see why here. We do that in a minute. Okay, so now we've done step 1, and that is to figure out the amounts of the individual dividends up to the start of constant dividend growth. Now we have to figure out a price at that same time that represents the present value of all the dividends going out beyond that. And to do that, we're going to use this formula right here. That price that represents the future value, or the present value of all those future dividends, is just D5 times 1 plus G divided by R minus G. But I need to make a little change here, because what is the growth rate? Is it the same one that we were just using? No, now we're looking at the second growth rate. So I'm going to go ahead and put that on there. Okay, now I've got on my screen right now something that represents D5. Is that correct? And so all I have to do is take this number and multiply by 1 plus G2. That second growth rate is 10%. So I'm going to multiply by 1.1. So this number right here is actually D6. I'm not going to write it down. I'm not going to store it or anything like that, but that is D6. Now I'm going to divide by R minus G2. How do I do that? I'm going to hit this division here, open parentheses, and I'm going to put in R, which they said is 15%, minus 0.1, close parentheses, and there is what it equals. Now, this number that I've got right here represents P5. But here's what you need to catch on to. C01, oh, that one sucks. C01 is equal to D1. C02 is equal to what? D2. C03 is equal to what? D3. Okay, someone besides Yaro. C04 is equal to? Did you change your name? I said someone besides Yaro. Oh, okay. Hi. And now here's the fun thing. What does C05 equal? Mr. Letterman, what do you think C05 equals? Oh, I called on the wrong guy. Debbie, what do you think? No. Okay, we're receiving 2 cash flows at time 5. This is D5, and that's P5. And so the 2 cash flows we're receiving at that exact same time. So this thing is going to be D5 plus P5. So we're collecting that D5, and then just in your mind think that we're selling it for P5 right after we collect that dividend. And so now all we have to do, right now on our screen, we have a number that represents P5. What do I need to do to that number in order to be able to get D5 plus P5? You guys remember where I stored dividend 5? Yeah, so I'm going to say plus recall 5 equals, and then I'm going to say enter. Okay, now cross your fingers, because if we did this correctly, we should get the right answer. Let's see here. Oh, by the way, how do I figure out the present value of all the things in the CF worksheet? What button do I hit next? NPV, very good. NPV, and what do I put in for I? Yeah, this is a 15% required return on this project, or on this stock. 15, enter, arrow down, compute. What that tells us is that this stock's value is $27 per share. Now, why do I know it's per share? Because those dividends were per share. Does that make sense? So if we take the per share dividend income and find the present value of it, that's going to give us the value of the stock per share. Would you like to see that one more time? Yes. Okay, very good. So first thing I'm going to do is say CF second, clear work. What do we put in for CF0? Yeah, arrow down. What do we put in for C01? 1.15. Enter. Oh, by the way, what else do I have to do here? Yeah, store 1. Okay, now I'm going to arrow down. Leave that as it is. Arrow down. What do I do here? Recall 1. And what do I multiply by? 1.15, because that first growth rate is 15%. Equal. I'm getting 1.3225. What do I do here? Two things. Store 2, and I got to hit enter. If I don't hit enter, it's like it never even happened. Okay, arrow down, arrow down. What do I do here? Yeah, recall 2. And then we're going to multiply by what? 1.15. And I'm going to hit enter, and I'm going to hit store what? 3, very good. Arrow down, C04, what do I do here? Read, what do I do? Yep. Yep, very good. Hit enter first. Yep, very good, he was listening. Store 4. That's always one of the proudest moments of a professor's life, when a student... Okay, let's see. That's 4. Now we're going to arrow down, arrow down. What do we do here? Madeline, what do we do? Recall 4. And what are we going to multiply by? Very good. 1.15 equal, and what do I do here? I'm going to store 5. Do I necessarily need to enter this? No, this isn't going to be our final number. Because remember, we got two things going on at time 5. We're collecting the dividend, and then we're selling the stock for P5. Okay, now, this is D5 right here on my screen right now. How can I get to P5 from there? Well, I have to take D5 times 1 plus the second growth rate divided by R minus the second growth rate. So what am I going to multiply this number by right now? 1.10, because the second growth rate is 10%. Now I'm going to divide by R minus G2. How do I do that? I hit the divide button, open parentheses, 0.15 minus 0.10. That's the second growth rate. And I hit close parentheses, and then I hit equal. That gives me $44.25. That $44.25 only represents P5. In order to figure out all of the money at C05, I have to add back D5. Where could I get D5 right now? Yeah, recall 5. So I'm going to say plus recall 5 equal. I'm getting 46.26. Now, what button do I need to hit next? Enter, very good, or it's like it never even happened. Now, how will I find the present value of all those cash flows? I'm going to hit NPV. What do I put in for I? 15, that's the required return, which is just coincidentally the same as the first growth rate. 15, enter. What button do I hit next? Oh, are you sure? Oh, it's 2 strikes, Yarrow. Okay, so arrow down, and then what do I do? Compute, very good. I'm getting $27 per share. Okay, now, Mr. Letterman, looks like all the life has gone out of him. And I'm going to tell you there are 40 questions on exam 2. How many of them do you think? Yeah, I'm only going to have you do one of these. So my first piece of advice is when you get one of my exams, any of my exams, always go through, and by the way, I'll let you go back and forth, right? Always go through and answer the easy ones first. In my wife's line of work, they call that the small wins theory. It boosts your confidence, you're feeling good, right? And then you go back and you try the medium ones. And you answer as many of those as you can. And then at the end, when you've got plenty of time and you're all relaxed and you're feeling great because you've already answered 39 questions correctly, whoop, that's when you do this one right here. Does that make sense? I tell people this all the time. And keep in mind that the questions are presented in random order. And so some poor soul will undoubtedly get this as their first question. And they will sit there for 30 minutes trying to solve this thing, and then they'll be and through the rest of the exam. And it will ruin their lives. Don't do that. Don't do that. There's a reason I let you go back and forth on the exam. Okay. By the way, all the questions are worth exactly the same. The easy ones and the hard ones. Make your life easier. Do the easy ones first. Okay, now we've been talking about G, and we have not given you any way to think about how to estimate G. And that's what we're going to talk about here. The first of all is the historical average dividend growth rate. If I told you that in year 1, the dividend was $1, in year 2, it was $1.10, and in year 3, it was $1.21. What would your best guess be for its growth rate? Let's just go take this one at a time. Going from $1 to $1.10, what was the growth rate? Oh, 10%, thank you. 10%, the one guy that was educated in grade school without a calculator. Okay. Okay, for those of you who are mathematically challenged, it would be 1.10 minus 1 divided by 1, and that would give you 10%. Okay, now the next one is going to be a little harder because we're going to have to take $1.21 minus $1.10. That gives us 11 cents. 11 cents divided by $1.10 gives us, once again, 10%. Now, if I were to ask you, what is your best estimate for the growth rate of these dividends over time? Your answer would be 10%, which is just the average historical growth rate. And that's frankly how I prefer to do this. However, what if your stock doesn't have a lot of history? Or what if it only recently started paying dividends? You don't know what this constant rate is. I mean, there's all sorts of freaky things going on there. Something else you can do is to estimate the growth rate by taking B times ROE. What is ROE? Camden, what is ROE? Return on equity, very good. Now, let's ask Debbie. Do you remember what B is? Wow, the plowback. I am very pleased that you remembered that. The plowback ratio. I think that's worth a coin. Here we go. Are you ready? Okay, I'm going to throw it harder today. Whoa! All right. Okay, plowback ratio. Now, why in the world is this the way it works? So keep in mind that the plowback ratio is the addition to retained earnings over net income. And so it represents what part of my earnings I'm putting back into addition to retained earnings. And addition to retained earnings is part of the firm's, or the accumulated retained earnings is part of the firm's equity. equity. So we're talking about our ability to grow internal equity here. And so that's why this growth rate, we can estimate it as the plowback ratio times what is the return on that money that we reinvest? ROE. So this should be on your note sheet. And in fact, there will be one very simple question that says, what is an estimation for G? And it'll have choices like B times ROE, B divided by ROE, B minus ROE, B plus ROE. And you'll be amazed at how many people do not get that correct. So that should be on your formula sheet. Now, let's do some cautions regarding this model. First of all, it only works for firms with constantly growing dividends. If the firm's got dividends doing this kind of stuff, it doesn't work. If we're going to use this to calculate our required return, I want you to notice that it's very sensitive to G. If our estimate of G is 1% too high, so 0.01, higher than it should be, what does that mean for our estimate of R? Oh, come on. If this one is 0.01 higher, what does this thing have to be? Yeah, it's just 0.01 higher, right? And so if our estimate of G is off by, or is too high by a certain number of percentage, our required return then that we use is going to be exactly the same amount higher than it should be. Conversely, if our estimate of G is too low, then our required return that we figure out from this will be too low. Why does this matter in the least? Remember that the price or value of anything is the present value of the future cash flows. If our estimate of R is too high, then our estimate of present value will be too low. If our estimate of R is too low, then our estimate of present value will be too high. You see how that works? And so if I go through, and by the way, we're getting around to NPV. What I'm going to do is I'm going to sum up all these present values and subtract out the initial investment. That's going to give us our net present value. And we make decisions on investing based on net present value. If it's greater than 0, we invest. If it's 0 or below, we do not invest. And so what happens if I am underestimating my growth rate? I underestimate R. It means I'm overestimating my present value for all the future cash flows. And that means that I'll be overestimating my NPV. The danger is accepting a bad project. If we underestimate G, then we underestimate R, and that makes us overestimate present value, which means that we overestimate NPV, which means that our calculated NPV may be positive when the actual NPV is not. And so that's the risk there is accepting a bad project. Now let's go the other way. What if instead we overestimated G, then we will have overestimated R, and we will have underestimated present value, which means we will have underestimated NPV for the project. If we underestimate NPV, the risk is rejecting a good project. The risk is rejecting a good project. Now I'm going to ask you a very thought-provoking question here, and that is, what is worse for your career? Accepting a bad project or rejecting a good project? It is better. Yep. So, okay, so here's the deal. How do we know a crime's happened? There has to be evidence, right? if you reject a good project, what's the evidence? Yeah, there is none, right? But if you accept a bad project, what's the evidence? Yeah. Okay, so I will give you a true, from my own personal experience example of this. I had a colleague named Joe, and Joe made this mistake on a factory that is still sitting at Steele's Corner Road in Cuyahoga Falls, Ohio. And he made this mistake, and he accepted a bad project. And so every time I drove by that plant, I'm like, whoop, there's Joe's mistake. Every time, right? I made a mistake that same year, rejecting a good project. Does anyone drive by it? Nope. Do you think Joe still works for those people? No. Okay. Does that make sense? By the way, some of you are saying, woohoo, this is Yarrow. He says, I know what I'll do. I'll just reject every project that comes along, and then everything will be just fine, right? And so Yarrow thinks he's pretty clever. And at his annual review, I say, Yarrow, I see you haven't accepted any projects this year. Yarrow's like, yes. I'm like, well, you know, I've got a positive NPV project of my own, because right now I'm paying you $100,000 per year. I'm going to fire your ass, and that $100,000 a year savings going forward, that's going to be a positive NPV project. If you never accept any projects at all, I don't need you. Does that make sense? Okay, so now let's talk about growth opportunities and what they do to the value of the firm. So we have, let's start with the very simplest kind of firm. It's a firm that has no growth opportunities whatsoever. By the way, there's nothing wrong with having no growth opportunities whatsoever. I'm as tall as I'm ever going to be, and I'm perfectly fine with that. And you could be in a company and have no growth opportunities. It doesn't mean it's a bad company. What it does mean is that it's not going to grow, and that the earnings per share are going to be the same from now until the end of time, because there's no growth. Okay, now the other thing that we know about such a firm is how much should they be plowing back into the firm? Nothing. Why nothing? They've got no growth opportunities. What are they going to be investing that in? And so that means that all of those earnings per share should be paid out as dividends. And so for this cash cow firm, we are going to say that the present value of that firm, or the value of that firm, is just the present value of all the future dividends, and they're all the same. And so we just use our constant dividends model to price that. Okay, now I want to explain the term cash cow to you. And as I recall, none of you grew up in the farming area, so I'll explain to you how this works. Cows, why are cows valuable? Milk. So, having grown up on the milk farm, let me tell you how it works. In the morning, all the cows line up. And it's always in the same order, because there is a cow pecking order. And Bossy's in front, right? Okay, so and then you bring them all in, and you milk them, and you get basically a set amount of milk. And then in the evening, it happens again. Whoop, the cows line up. You don't even have to go down and ring a bell or anything. The cows are there and waiting. And you let them in, and you milk them all, and you get roughly the same amount of milk. And so every day, I'm getting the same amount of milk over and over and over again. This is how these cash cow firms are. Every period, I'm getting the same amount of cash out of them over and over and over again. That's why we call them cash cows. I will say one thing, though. I think cows are more similar to bonds, and that daily milk is your coupons. And then when the cow gives her last, what happens? McDonald's, right? She becomes hamburger. And so you've got all your daily milkings here. Those are your coupons. And then you've got selling Bossy to the stockyard to go to McDonald's. That's your big face value at the end. Okay, but I digress. Okay, so what if, though, a firm has growth opportunities? Well, we know that that means that there's going to be more cash flow in the future, and so that firm's got to be worth more. How do we calculate what that value of more is? We use something called the NPVGO model, the net present value of growth opportunities. And this is where we take per share, or we take the sum of all the projects that we're doing. And by the way, they should all be positive NPV. I'll tell you why we might do negative ones later, but for right now, positive NPV. We're going to add all those together and divide it by the number of shares. And that extra amount of money should be, we should be able to add that on top of the cash cow portion, and that should give us the value of the stock. So I'm going to give you an example here. Hopefully you guys are familiar with Google, or Alphabet as it's called now. And they have a cash cow portion of their business. You guys may not even realize what their business is, but they basically are selling something called AdWords. If you are selling something called toe cheese for whatever reason, and you want your results to be top on the list of sponsored stuff, you just need to outbid everybody else for the search term toe cheese, and yours will pop up to the top, right? And they make billions and billions of dollars, and just over and over and over again. That's the cash cow portion of their firm. Now, they do have stuff up here. They're trying, by the way, to maximize this growth rate. What's the goal of financial management? Maximize shareholder wealth. So if I can grow the firm, I want to, right? And so you look at all the things that are up here, and Google's done some crazy stuff. So let's talk about, so they were doing balloons with internet. Do you guys know about that? It was an experiment. It failed. And then they also did Google Glass. You guys remember how that ended? Everyone that wore them, people started referring to them as glass holes. Oh yeah, it didn't go well for them. This is way before Ray-Ban and Meta and whatnot. Okay, let's see what else they did. How about Google Maps? Yeah. What about Android? Are all these bets going to pay off? No. But our very best estimate of their payoff, our swag, is the NPV for each one of these. So what I'm going to do is I'm going to add all these net present values together and divide by the number of shares. And that's going to give me the price of the stock today is equal to the earnings per share divided by the required return. That's the cash cow portion plus this growth portion. Now, am I going to ask you to do calculations using that? Most likely not. Here's what I want you to get out of that. We're going to talk about the PE ratio. Hopefully you guys have heard of PE ratio before. We talked about it, I believe, in chapter 3. It's the price per earnings ratio. One way to think of it is how much investors are willing to pay for $1 of current period earnings. And you say, why would they be willing to pay more for $1 of current period earnings for some firms than others? And that's what we're getting ready to answer here. So here's what I'm going to do. I'm going to take that formula we just talked about, P0 is equal to EPS over R plus NPVGO. I'm going to divide every single thing there by EPS. So if I take price per share and divide by earnings per share, that gives me the PE ratio. And if I take earnings per share, divide by R, and divide by earnings per share, that leaves me with 1 over R. And then my last term will be NPVGO divided by EPS. So let me interpret each one of these for you. First of all, we know that R represents return, and return and something else must go together. What are they? Return and risk, right? And so we know the higher the risk is, the higher the return, the lower the PE. Let me say that one more time. The higher the risk, the higher the required return, the lower the PE. Okay, now the second part, and by the way, that first part doesn't seem to come into play a whole lot when we start talking about the growth thing, kind of outweighs it. Let's talk about NPVGO divided by EPS. The way to think about that is, how big are our growth opportunities versus our present business? If our growth opportunities versus our present business are very high, then this number is going to be large. And when that number is large, then PE is high. When our growth opportunities are very small compared to our current business, that number is low. And so your PE ratio is low. So what kinds of firms have a high PE ratio? Ones with low risk and lots of growth opportunities. By the way, how often do you think you find a low risk firm with lots of growth? Yeah, very seldom, right? Okay. Now, using what we've just learned, let's talk about some PE ratios. Oh my goodness, these are almost 11 years old. I need to update them. But here we go. ExxonMobil. Do you guys know who that is? Exxon, we're just kind of doing a baseline here. That's an integrated energy firm. We got a PE of 12.6. Right now, you don't know whether that's high or low. Let's move forward with Ameren. Are you guys familiar with Ameren? Are they in St. Louis? No? Okay. Ameren, they are an electric utility. So what do you think the growth opportunities before AI were for electric? About 2% a year, right? It's not all that big until AI hits. Now the growth opportunities for people like this are much larger. What do you think that means about the PE for Ameren today versus back then? It's almost got to be higher, right? Okay, Newmont Mining. I just threw that in there because people like to talk about gold. Let's talk about Starbucks. Starbucks has a PE of 31 as of that date. Why do you think Starbucks has such a high PE ratio? Is it because it's extraordinarily safe? No, it's because it's growing. This is so funny. My wife and I, we moved to Hattiesburg, Mississippi in July of 2006. And we were driving into the university the first time to get our badges and whatnot. And we see there's a Starbucks on the way. I'm like, oh, hey, look, there's a Starbucks. And then when we start school, we're driving in and there's another Starbucks. I'm like, wow, there's another Starbucks. A month later, we're driving along, there's another Starbucks, right? Crazy, crazy growth. That's why the PE ratio was high. Now, at some point, though, do you think they reached saturation in the United States? Absolutely. So what do? Yeah, they go international. And so people, Starbucks, they said, well, so where are you going to go next? And they're like, we're going to China. And everybody laughed because everybody knows China is a tea culture, right? China is a tea culture. Well, everybody laughed. I laughed. And then in 2011, I go over there to teach, and I step out of the hotel first thing in the morning. I'm stretching, and I look across the street, and boom, there's a freaking Starbucks. I'm like, crap. And there were people there. And then I get to class. By the way, class starts at 8 a.m. And in China, they eat in the classroom. They eat their breakfast. And it smells funny because it's not American breakfast. It's like got peppers and onions and shit. Anyway, but the girls sitting on the front row all had their Starbucks cups. I said, is that really Starbucks, or you just keep refilling the same cup? They said, no, it's really Starbucks. I said, question number 2, is it tea or is it coffee? What do you think they said? It was coffee. I'm like, holy crap. Starbucks got Chinese people to drink coffee. Now, they take over a lot of business there in China. And then they ask, well, Starbucks, where are you going next? And Starbucks says, India. And people were like, India is only a half coffee culture. So the bottom half of India drinks coffee. The top half of India drinks tea, like China. And so people were poof on. I'm like, don't bet against Starbucks getting tea drinkers to drink coffee. I've seen it. They can do it, right? And so that's how Starbucks grows. They go in and they grow internationally. Now, eventually, will they saturate the market? Yeah. And now they're starting to see new entrants like Luckin Coffee over in China. Luckin is really big. And the main reason they're able to take over is because they don't charge as much for a cup of coffee. Okay, so that's Starbucks. It's the growth story. Now let's start comparing some people. How about Walmart and Costco? What? Go ahead.
I have a question about the Starbucks.
Okay.
Why do you think the Starbucks has grown so much compared to other coffee shops?
Okay, so first of all, they found a niche. And the interesting thing is, what did they think their niche was in the beginning? It's like your second living space, right? It's where you go to meet with your friends, and so it's a social place, plus it's the artistry of watching the barista at work, right? And then someone said, well, wait a minute, couldn't you guys make more money if you put in a drive-in? Oh, absolutely not. Why would we put up a drive-through when it's the experience of watching the baristas, our highly skilled baristas, create your drink? Well, it turns out Americans don't give a damn. And I could prove it to you. Just drive down Glenstone and look at the line at Starbucks any freaking time at the drive-through. Okay, so the first thing was that they came up with this really unique kind of thing. And the second thing was that they were willing to walk away from it, right? They were willing to go beyond just that thing. Now, why are they in trouble now? Because it's fairly easy to replicate what they've done, right? And if you don't mind not having the Starbucks, what is that, mermaid thing or whatever on there? If you don't mind your thing saying luckin' and having a deer with antlers on it, then you're perfectly fine paying half as much for a cup of coffee, right? Can Starbucks then afford to lower their prices? No, why not? Oh, okay, so the unions, yeah, that's true. But more than that, they've got a brand to protect. Yeah. So do you ever see Rolex advertised as on sale? No, why not? Yeah, they got to maintain this exclusivity, right? Oh yeah. I don't envy you people having to do business, but I certainly enjoy watching it from the sidelines. Okay, now let's talk about. Does that answer your question?
Yes.
Okay, let's talk about Walmart and Costco. Just in your mind, picture what it's like to be in a Walmart, and then picture what it's like to be in a Costco. Which one's more pleasant? Costco. Why? Okay, you got hot dogs. I like that. It's what? Not as trashy. And he just means that it's not as they do a better job keeping things clean at Costco. Also, I have never seen anybody change a baby diaper in Costco, and I've seen that at Walmart, and it was in Texas, and the baby's family had obviously been feeding him lots of chilies. Okay, on with the story. So it's a more pleasant environment. What about the help at Walmart versus Costco? Costco's better. Why? They pay them more. So if you were a high quality level of retail service individual, would you prefer to work at Costco or Walmart? Costco. Now, nothing against Walmart. I love Walmart. They've done a lot for poor people. I'm not kidding. The standard of living in the United States is so much higher because of what Walmart's done for us. Because when I was a little kid, we had Walmart store number 13 in my hometown. I'm not kidding. We had Walmart store number 13. And but at the time, most everything else was small independent shops. No economies of scale. What do you think that meant for the prices at those shops? Yeah, they had to be high. As a result, a family's income did not go as far. But as soon as Walmart starts carrying something, suddenly everyone in town has to come down on that item, right? And so the cost of living is so much more affordable. So don't what you think I'm smacking on Walmart here. I love Walmart. Okay, now back to, I just don't like to go into them. Now, back to the story. So you've got cleaner place, you've got more motivated employees. And so I would say generally that Costco executes better. You know what I mean by execute? They do a better job at this thing that they're doing. How often do you go into Costco and find an empty shelf? Seldom. How often do you go into Walmart and find an empty shelf? Yeah, all the time. So Costco just executes better. So that's one reason they've got a higher PE ratio. But here's the big one. How much room does Walmart have to expand in the United States? Not much. In fact, they've contracted. They've actually shut some stores down. You say, well, certainly there's international I've been to Walmart in China, and they were selling bullfrogs, and you might think they were doing that for pets, but no, it was for dinner, right? Oh yeah, and the bullfrogs would occasionally escape from the tanks, and then someone would go catch them and put them back. Okay, now there were, when I went the first time to Dalian, I think they had 3 Walmart. I think now they are down to 1 Walmart. Walmart tried in South Korea and failed. Walmart tried in Germany and failed. So Walmart is kind of growth constrained. Now let's talk about Costco. Where do you primarily see Costco? Primarily along the coast in the US. The one here in Springfield is a recent development. Costco has much more room to grow than Walmart. Costco has much more room to grow. And so that's why their PE ratio is higher. Now let's talk about Apple and Lenovo. Apple and Lenovo are in the same business. What do they both, do you guys know what Lenovo is? What is Lenovo?
They make laptops. I use their laptops.
Yes, so they bought IBM's ThinkPad line, and that's become the Lenovo ThinkPad. And then they have also, they're into mobile phones. And their mobile phones run on Android, which Google supplies for free. Look at Apple. Apple has to develop their own software. And of course, Apple has kind of like that Starbucks cachet about it. And so that means that they're much more expensive. If I ask you, who has more growth opportunities? Companies who sell to rich people or companies who sell to poor people? Which one has more growth opportunities? Yeah, selling to poor people. By the way, if you did not know this, there are way more poor people than there are rich people. So the average American thinks having an iPhone is, but if you go to, let's say, in Ghana, is having an iPhone the normal thing? It is. Whoa, Ghana's got more money than I thought. If you go to, let's see, Vietnam. Any Vietnamese here? What's more popular, iPhone or the Android phones? Wow! Maybe Apple is taking over the world. Now, when I would have my China EMBA students, almost all of them, like N-3, would have an Android phone because it was cheaper. And then the other 3 were like children of very wealthy people. Okay, so Lenovo has got more space to grow. And by the way, apparently Vietnam is now richer and Ghana is now richer. But let's talk about India. There are rich people in India. They sell plenty of iPhones in India. But most people in India could not afford one. So that growth opportunity is much bigger for Lenovo, which explains why their PE ratio is higher. Now, Yahoo and Google. Yahoo's not even around anymore, right? So at the time that I took this snapshot, Google had 5 times the PE ratio. Why? Because Google was growing and Yahoo was dying. Pfizer and AstraZeneca, these are both in the pharmaceuticals market. When we talk about how to value, and this is something that you'll learn in your financial analysis stuff, Yarrow, when we're valuing pharmaceutical companies, the primary thing we're concerned about is their pipeline. What's their pipeline? Yeah, so it's what is in their pipeline on the way to being approved for sale. And so it starts out back here with a couple of nerds in a lab, and they find a promising compound, and then they lobby to get funding to advance their research. If it's any good at all, then they get some money to go buy some mice, and they try this stuff on mice, and lo and behold, the mice regrow their hair. And so they're like, whew, this stuff works. And so they're like, okay, what do we do next? Well, let's get some monkeys. And they get some monkeys and they shave the monkeys and they give them this new pill. And sure enough, the monkeys grow out these really bushy, nice flowing manes. They're like, damn, that's good stuff. So what do they do now? Well, they have to get some approvals in order to be able to do human trials. And so then they do human trials, a small one to begin with. And then suddenly these people all have magnificent hair, much like Reed. And then they're like, yeah, this is some good stuff. And so then they have to do large-scale trials. And then after that, they have to submit all their data to the FDA, which, by the way, is a branch of the United States government, which is just about as efficient as the DMV, right? So how much time are we talking about here? Yeah, years. Okay, but the cool thing is, because it's a regulated process, everybody has access to where the drugs are in the pipeline. So people doing the CFA thing, trying to figure out what the company's worth, they have a lot of visibility as to what's coming down the pipe. Do they know how popular it will be? No. But they do know what's coming down the pipe. Now, just looking at Pfizer and AstraZeneca, which one do you think had a better pipeline at the time this picture was taken? Yeah, AstraZeneca by far, right? Do you think it's always the same that AstraZeneca's always got a better pipeline? No, they go back and forth. I remember right before Pfizer came out with a drug called Viagra, they had a great pipeline. If you don't know what that drug is for, Google it, right? But they had, and Bob Dole ran for president in 1996, lost. And do you remember what he did? He did a Viagra ad during the Super Bowl. And he's sitting by a golden retriever dog. And then there was an ad with Britney Spears and Pepsi. And I get all that mixed up in my head. And I think Bob and Britney are together with the dog. And, well, anyway. It would be. They probably could have sold more Pepsi. Do you think they really needed to sell hard with the Viagra? Not if you know what it's for, right? Okay, so but at the time, their PE ratio would have been amazing because people recognize, boom, that's kind of like with these weight loss drugs. Do you think we really have to wait to see if people are going to be interested in the weight loss pill? Oh, we know they're going to be interested in the weight loss pill. So right now, the people who are developing those weight loss pills, they've got high PE ratios because they've got this great pipeline. Does that make sense?
Is that really the only factor?
It's the big one. Oh yeah, it's the big one. And keep in mind that there's this cash cow portion, right? But probably the bigger thing is that growth. Yeah, PE and growth. If you see two firms in the same industry and one of them's got a higher PE, growth is usually the story. Oh yeah. So just like with NPV, everything we're talking about here is a scientific wild ass guess. Do you think that people take into account the potential costs of lawsuits? Yeah. So I'll run you back to the year 1973. I'm 2 years old. Ford comes out with something called the Pinto. Have you heard of the Ford Pinto? Little compact car designed to fight the Japanese. Okay, now, here's the fun thing. In their testing, Ford found out that if struck from the rear, the Pinto was more or less a firebomb. And they actually had the technical reports from the engineers. And the engineers turned those technical reports over. And by the way, the engineers said it would cost something like $3 per car to keep this from happening. They turned it over to the bean counters, and the bean counters approached the lawyers. And they asked the lawyers, well, what do you think our exposure would be here? And they sit down and they figure out, well, we figure we'll be killing about 155 people a year, and each person is worth, and this is the part that really pisses people off when you start putting a number on human life. Each person probably costs us $20,000 at the time to settle because people are pretty worthless. So 155 times 200,000, way cheaper than $3.10 extra per car to keep this from ever happening. Do you think the same calculations get done at drug companies? Oh yeah. Oh, they damn well better be. They better be, because if you're like, yeah, but this could cause someone's skin to peel off. Should I take that into consideration before investing in it? Absolutely. Does that make sense? Have you guys seen the show called The Beauty? It's on Hulu. And it really is kind of making fun of this whole the weight loss drug thing and what it's doing. It's worth a watch. Okay, back to the story. Now, last two we got up here. At the time, Amazon did not have any earnings at all. For the longest time, Amazon, this was their model. Lose money, lose money, lose money, lose money. And then the market would start rebelling. And analysts would start saying, I don't think Amazon's ever going to make any money. And then miraculously, they would post positive earnings. And their stock price would whoop, go up. What do you think they did then? Lose money, lose money, lose money. And why are they doing that? They're investing so much in the business that they're basically constantly losing money. Their depreciation is really high. Now, eventually, of course, they start making money. But at the time that I came up with this chart in 2015, they had no earnings at all. How can you figure a PE ratio when you've got no earnings? Or worse yet, how could you figure a PE ratio when you've got negative earnings? You can't do it. So that's why NA was there. Now, what about Alibaba? At the time, Alibaba was the fastest growing e-commerce company on the planet. I really need to update this because some of these companies are dead now. Questions? Yeah, Alibaba's still around.
So how, like, I've read a little bit into it, but like, can you explain more? How was Amazon able to like be so, I guess, profitable? It's not the right word, but like successful if they were never, like, if they always had negative earnings.
Okay, so keep in mind that what we are valuing is the present value of future dividends. So it's kind of like a leap of faith. I'm going to put my money into Amazon because I believe that after they get through with this build out, they're going to be very profitable.
Yeah.
And it's kind of turned out to be true. But do you think it's true with every company where people? No. So yeah, Amazon spent a lot of money. The other thing that's going on with Amazon, a lot of people don't realize this. Where does Amazon's money really come from? Is it from those packages that show up on your porch? Yeah, it's Amazon Web Services. And they're using it to subsidize that stuff that shows up on your porch. There is no way, okay, so I ordered some vitamins. They are going to bring a single bottle of vitamins to my porch today and set it there. And those vitamins cost me like $4 or $5. That doesn't even cover the shipping. How's Amazon making it then? It's AWS. What does that mean for people like Walmart that has to compete with Amazon? It's really tough, isn't it? By the way, Amazon is freaking ruthless. Amazon is automating as much of their stuff as they possibly can. And it's not enough apparently to win. You gotta cause the other guy to lose too. So what does Amazon do? Amazon comes out and says, well, we think that people should get paid, at the time it was like $15 an hour, when everyone else was paying like $12. What does Walmart have to do now? They have to bump up. Now, why does it hurt Walmart more than it hurts Amazon? Walmart has more people, right? Isn't that cruel? It's like war. Yeah, there's a reason Bezos is really rich. I personally think the reason he is so driven to succeed is because he's 5'7". Questions? Okay, so that is the end of the calculations. You have enough to be able to do your homework now. And we will jump into stock features a bit here. And then we will take a vote. So first thing so we've got common stock, we've got preferred stock. We're going to start off talking about common stock. And one of the things that you need to know about dividends is that companies are not required to pay them. Companies are not required to pay dividends. And so they are not a liability of the firm unless they're declared by the board. A liability is a legal obligation to pay. Just because a company's been paying $1 every quarter for the last 10 years, what does that mean the next dividend has to be? It doesn't have to be anything because the board has to declare the dividend once per quarter. By the way, that is an excellent test question. I'm going to ask you if a company's been paying a dividend for a really long time, do they have to pay the dividend? And the answer is no. Payment of the dividend is not considered a business expense. Therefore, it is not tax deductible. And so equity has a tax disadvantage compared to debt. And dividends, in fact, this one's changed a little bit. since this version of the text. Now it's a 50% corporate exclusion. So when you receive dividends, it used to be really simple. If you received dividends, then you paid on them as if they were ordinary income. So richer people paid a higher percentage on their dividends than poor people. Now, they changed the law to where it was a flat rate. And no matter how rich or poor you were, that's what you paid. Now we've got some sort of weird system where they've got qualified and unqualified, and you can get by with this much dividends every year as long as you don't do this. It's very confusing. But long story short, typically individuals have to pay taxes on dividends. Corporations really only have to pay taxes on 50% of the dividends they receive. And you might say to yourself, why would that be? And the answer goes back to that double taxation. You remember that corporations, they pay corporate income tax, then they pay the money to the shareholders, and the shareholders have to pay dividend tax. If one company owns another company's shares, they will receive dividends from there, and they would have to pay taxes on that. Then they have to, and by the way, the first company pays corporate taxes, pays dividend to the second company. The second company has to pay taxes on that, and then pays it out to the shareholder, who has to pay a third set of taxes. Apparently, in the United States, double taxation is perfectly fine, but triple taxation is a step too far, and we just can't have that. And so that's what's going on there. Sometimes people say, well, wait a minute, it's these fat cat billionaires. No, it's really not fair to try to triple tax this stuff. So what are the shareholder rights? The rights to vote on matters of great importance. What's the big one? Voting for the board of directors. Remember, the board of directors represents the shareholders. The second one that may come in a distant second would be voting on mergers and acquisitions, things like that. In the United States, we have something called proxy voting. You don't have to be present at the shareholder meeting to vote your shares. You could just fill out your proxy ballot and mail it in. Or these days, I can just go online and do it. We take that for granted in this country. In Europe, they don't have proxy voting. And so you have to actually attend the shareholder meeting. Remember earlier I told you about cows having to get milked twice per day? Let's think of a dairy farmer in Marseille. Marseille is in the south of France. And there's a shareholder meeting in Paris. And the farmer has 10 shares in whatever firm. Do you think that the farmer is going to jump in his Citroën and drive to Paris and vote his 10 shares after milking the cows, and then jump back at his car, drive like crazy back to Marseille to get home in time for the evening milking? Absolutely not. And so what we see is in countries without proxy voting, the minority shareholders, meaning people with very small shareholdings, they really don't get represented in the decision making at the company. It's just the big block shareholders. In the United States, anyone can voice their opinion. Do I ever turn in my own proxy ballots? Only for Halliburton, and only to vote against this guy named Lord Clitheroe. I frankly, anyone in royalty, I'm just like voting against him. Okay, we have the right to share proportionally in all dividends paid to the common shares. If you own 10% of the common shares, you will get 10% of the dividend paid to common shareholders. And to share proportionally in all assets remaining after liquidation. Remember, the common shareholders are here at the very end. If I own 10% of the shares after everything else has been paid off, everything's been sold, if there's any money left in the pot, I get 10%. Questions? Okay, now, choices. We can either continue this and finish next time, or we can do exam review. You can bring your questions, and then I will cover as much of the stuff as I can after, and you can ask questions. Which would you prefer to do? Option A, raise your hands. Option, oh. Okay, have you read the options now? Okay, option A, raise your hands. Option B, raise your hands. Okay, we will be doing option B. Watch the video, stock features.